Before we dive in, well, here's your obligatory public service announcement. Never, ever shred or burn your money. Instead, focus on learning how to avoid the 3 deadly mistakes that can quietly destroy your portfolio. Okay, maybe not that kind of destruction, but let's get started. Alright, I'm going to open with a bold statement. In the next 3 minutes, I'm exposing the 3 deadliest investing mistakes that are silently killing your returns. Now, those of you who watch regularly might think, hold up, and didn't you just cover the most common investing mistakes last week? Yes, I did, but those mistakes are rookie-level stuff. Today, we're going pro, tackling the mental and emotional barriers that keep most investors from building wealth. So whether you're a veteran or still learning the ropes, fasten your seatbelts. This is going to be a wild ride. Mistake number 1, emotional decision-making. You see, the single biggest threat to your investment portfolio isn't market crashes, recessions, inflation, interest rates, or even rogue hedge fund managers. It's you. Your brain is wired to make you a terrible investor, programmed to flee danger and chase what feels good. When markets tank, your amygdala, the fear center of your brain, lights up like Times Square, screaming at you to sell everything. When markets soar, your brain floods with dopamine, begging you to buy more at peak prices. And the worst part? This biological hardwiring happens at the exact time you should be doing the opposite. The data is brutal. The average investor underperformed the S&P 500 by 4.2% annually over the past 30 years, primarily because of emotional buying and selling at exactly the wrong times. So how do you fix something as complicated as human emotion? Start by acknowledging this pattern in yourself. Recognize when your emotions are taking the driver's seat and steer your actions with your rational mind instead. Next, create a written investment plan before market chaos hits. Document exactly what would justify selling a position, like missing earnings reports, changes in business outlook, or new regulations. Then when markets go crazy, consult your plan, not your feelings. Emotions are expensive, luxury items your portfolio simply cannot afford. Mistake number 2, obsessing over winners, ignoring costs. You see, nothing kills your returns faster than high investment costs. Yet most investors have no idea how much they are paying in fees. Consider this. A 1% difference in fees doesn't just cost you that 1%. Over 30 years, that small difference compounds to over $100,000 in lost returns, enough to buy a vacation home in some markets. Yet a study by Dalbar found that 39% of investors don't even know what they're paying in fees. They're literally giving away a third of their potential wealth without realizing it. So how do you avoid this silent killer? Simple. Audit every investment you own. Add up all costs, expense ratios, advisory fees, trading costs, and account charges. Then ruthlessly eliminate any fee that isn't delivering clear value. Sometimes the best investment decision is simply stopping the bleeding. Mistake number 3, the concentration paradox. Here's the ironic truth. Most investors own dozens of investments thinking they're diversified when they've actually created an expensive, unwieldy mess that all move together in market downturns. At the same time, they're dangerously concentrated in a single factor, usually US large-cap growth stocks. In other words, they've traded risk for the illusion of safety. So how do you escape this paradox? Easy. Simplify. Most investors need only 3 to 5 broad index funds, covering different asset classes or 15 to 20 individual investments. They truly understand. True wealth isn't built by owning everything. It's built by owning the right things and understanding exactly why you own them. By mastering your emotions, minimizing costs, and achieving true diversification, you could potentially add 3 to 5% to your annual returns. That's not just a number. That's potentially doubling your retirement nest egg. Now look, there's no shortage of investing advice out there, but most of it's garbage. We're not here to tell you what to invest in, but how to avoid the most common mistakes that keep people from building wealth. Because let's face it, investing shouldn't be rocket science. And the most important thing you can invest in is your own education. So if you found this valuable, hit that subscribe button for more wealth building strategies that actually work. Leave a comment below with which mistake you're committing to fixing today. I read every comment. And remember, investing success isn't about finding magical stocks or timing the market. It's about avoiding the minefields that most people fall into without even realizing it. Thank you for watching, and until next time, happy investing.